He picked his house.
All right, so making a quick video to be able to determine another method of determining a strike price for options trading on long positions. And this could also actually be used on when you're going short or buying a put. So let's take ARKF as our example and disregard the children speaking loudly in the background. Yes, please keep it down. I'm not talking about you. Okie dokie. So let's see, we're going to be picking a strike price for ARKF. So let's take a look at ARKF's daily chart here. We see that it had its pullback, long wick yesterday, went below the 50, found some horizontal support in this area. Let's go ahead and draw that line because you can see that there was a old support and an old resistance and an old resistance. So that's pretty significant over there of where it would stop. What's interesting is as you're going through the day, if we were looking at this yesterday, we're so focused on the drop, right? The big red candle that we would not have necessarily really have been paying attention to this unless, you know, you had been anticipating that that's where the move could go if it fell. And yesterday's move was going to fall pretty significantly. So seeing though that it had its bounce off of old resistance and a area that seemed to have been a support zone. And now it's kind of doing its doji thing, but it's still below the 20, below the 10, below the 5, converging down with still bullish sentiment though on the 200, the 100, and the 50, still spread out in an upward channel, upward direction, but it's dojiing here. So the question is, can we get back above the 50 and just continue with our trend? But as you can see here, I have these trend lines drawn in that it was just kind of bouncing between these two dashed lines, and it really just accelerated in the early part of February. So, I mean, this pullback is, it can be expected, and it's not a bad thing. Let's take a look at how much the drawdown was. I don't know if you can see that, but that's about an 18% pullback. Change this for you real quick so we can take a better look. So let me draw that line again. So from the top, from the high, all the way down, you can see in the blue box that's showing there, all the way down to the wick was an 18% correction, right? If we were down here still and moving further, that would be bearish, right? But this it looks to be more of a correction. Now we're back to where it closed yesterday up here at about a 9–10% correction zone. But down all the way here, it fell 18% from the recent highs. That's pretty good. If it stayed down that way, we'd be in bearish territory for this stock, not necessarily bearish for the market. But of course, in picking a strike price, right, if we're going to enter in something long-term on the strike price calculator with Monroes method, of course, we would go to the strike price calculator, and to do a 2-year play, we can go in here. I'll remove this and just go in and enter it in with today. We have a 10% correction on that we have on the amount, right? Let's consider a 10% correction occurring on the performance, and that would say buy a strike price as of today's prices on the low end for 2 years, buy the 79 or as high as the 82. So of course we'd go over here to the trade tab, go to January, we either buy the 79, which there isn't one, so you would buy the 80 on the low end, so that's the closest one there. Also has some pretty good open interest. Or we'd buy the high of 82, which doesn't even take you to 85, so you'd still be buying the 80 regardless. So still a pretty good selection in my opinion. If you, of course, you want to do the 1 year out, let's go to January 2022. And based on the strike price calculator, it's saying buy the 72 or the 73. And obviously that puts you right here at either hopping in at the 70 or the 75 on January 2022. And as with the chart pattern, I mean, seeing that it got to 64 and then pulled back, FinTech and ARK ETFs are still great companies that they have in their ETFs, so it's a good selection. Definitely can see it getting to 72 and 73 this year, right? Especially when it was already up at 64. And even if, let's say, even if it doesn't get to 72 by next year, or at least at the end of this year, it'll probably be in that range, and you would make some good money from even 57 running up to 64, or or more, right? But I can guarantee you, Kathy Woods is not about not making money with her ETF. So, but the purpose of this video is to talk about another way of selecting a strike price, and that is, I learned this from Tradeway, which is a Christian-based trading organization. And they prefer, and when you're looking at picking options, they like to pick options that are 2 to 3 months out. So that means that you would look at something that was 60 to 90 days in nature. You can go further if you like, but I think 60 to 90 days, maybe 120, you'd be pretty good. But looking at ARKF, we pretty much have a March monthly. We have some weeklies in between. We have an April monthly, and we have a July monthly expiration, monthly option. So the 142 is pretty far out. I don't think I want to go that far out, but what we would select in this case, being close to about 2 months, is the April. And so here we have the chain. Here's all of the strike prices that are available for the April expiration. And so with Tradeway's method, you're looking at selecting a strike price that is in the money, or at least at the money. And they're basing it off of what they would call a 50-50 split of intrinsic value and time value. Okay, so we're going to leave this up here. Nope, that's adding another box. I want that. So we're going to leave this kind of up here at the top, right? So we're looking for a 50-50 split of intrinsic value and of time value. And pretty much intrinsic value, or we're going to call IV, equals strike. It equals strike minus, it equals stock minus strike. So stock price minus strike price, and this is for a call. If we were doing it for a put, it would be strike minus stock, and that would be for a put, okay? So 2 different ways of determining IV. But we're going to focus on the call aspect in this particular video. And then the time value that we're going to call TV is determined by TV equals the premium that you're going to pay minus IV. Okay. So that would be premium minus IV. Premium meaning what are we going to pay pretty much on the ask, right? So let's look for essentially a 50-50 split. And that's what strike that they would recommend that you would select for an option. So if we see that the stock price here is right now $57.59, what we want to do is, and let me pull up the calculator, we're going to just pretty much start selecting or taking a look at what the numbers are. So let's just take the stock price, 57.59, and let's subtract, let's go right at the money, minus 54.82. So that equals $2.77. So our intrinsic value on this strike, on the 54 strike, is $2.77. So let's do that math real quick. So the IV here equals $2.77. So now that means that in doing the math, right, if the IV is the difference between stock and strike, then the TV is the difference between, TV for time value is the difference between premium minus the intrinsic value. So the premium you would pay is $5.6. So let's clear this. 5.6 minus 2.77 equals 2.83. So let's go here, select. So EV equals 2.83. And let's be very clear here. This is for the $54.82 strike price. Okay. So for the $54.82 strike, the intrinsic value is 2.77 and the time value is 2.83. So, and the premium here is $5.60. So that's pretty close to 50-50, right? If we just pull back up the calculator, you're looking at 2.77 divided by 5.6 of the premium, 49.4%. So that is pretty much the 50-50 split of intrinsic value and time value. So based on Tradeways methodology for selecting a strike price, they would recommend going 2 to 3 months out and picking a strike price that gives you a 50-50 split of intrinsic value and time value with the premium. So based on the math that we just did, if you wanted to get into the April 2021 expiration, you would select the $54.82 strike price because that would give you a perfect 50-50 split. And so why do they go with wanting the 50-50 split? It's because there is still intrinsic value, meaning actual value baked in to selecting this strike price, meaning that, again, the intrinsic value between the price of the stock and the price of the option is $2.77. So that means that, let's say this stock stays flat or goes up, comes down, comes back up. But by the time this expiration comes, the stock is still at $57 and $57 and 80-something cents or whatnot. You still have about $2.77 of time value that's baked in to the price, meaning that is at least what that contract is worth, because that's the value between the stock price and the strike. And you're in the money in that case as well. So that means if you wanted to exercise your option, you can buy the 100 shares, if you bought one contract, at $54.82 per share. And then you can immediately sell it at $57.50-something, as long as that price is still above it. So they like for you to have some intrinsic value still in the stock. So that way, you won't be losing a ton of money, even if it went in the opposite direction. It'll take a little bit more time, versus when you're out of the money, meaning you're picking a strike price that is higher than the current stock price. If it goes the wrong direction, you have no intrinsic value there. You're just losing time if it's not going in your direction. You could still make money as the stock starts to move towards your out of the money strikes, but it has to move there sooner than later, in a sense. And that's for when you're doing these shorter term, more like swing trade options, where you're picking something that could be 2 to 3 months out, or even 4 months out. Okay. So just to give another example, let's say that we picked instead, we looked at doing the 47.82 strike, right? So you can see how this is off. So let's say we're going to do, instead of the 54 obviously is the ideal strike price that we would select based on their math. But let's say you wanted to go for the 47.82 strike price. So again, let's pull up the calculator. And so we have $57.49 minus 47.82. That gives you an intrinsic value, of $9.64. Oh, gotta select that. So we have 9.64. And so now we need to determine the time value. And again, time value is the premium minus the intrinsic value. So let's pull back up the calculator. And so going to the 47.82, we have the premium is $10.80. We're going to subtract the intrinsic value of 9.64, and that gives us 1.16 of time value. And I don't think I have to do the calculation of the percentage there, but obviously that's nowhere close to 50-50. Of course, you could still select this strike if you desire to. If you have the funds and availability to, by all means, select that strike. But just the way that I was initially taught with Tradeways program, you want to get a strike price that's in 50-50 split, which is pretty much the sweet spot there. Another way of making it an easy picking for the 50-50 split is when you're looking at the delta. And if you pick a delta that's pretty close to a 50 cent delta, you're going to be getting, something that's going to be providing somewhere close to a 50-50 split. So you can kind of start there, or by practicing, just start with the strike price, do the simple calculation that we just did, and then you'll be able to find what your 50-50 split is. Okay. And so again, that is for selecting a call. It would be the same method if you decided to select for a put. So let's go to the right-hand side, and all this stuff's going to stay up here. But so let's say that you feel like it will continue to go down. This doji's starting to look like it may go down. But let's say you feel like it's going to go down and you want to play a put on it, and you would still select something that's 2 to 3 months out. But now we need to determine the 50-50 split of intrinsic value and time value on the put side of when you're going to buy when the stock goes down. So let's arbitrarily pick a strike. We can start again with looking for the 50-50. Again, you're going to be looking at or in the money. So let's just start off with the $59.82 strike. Okay, so let's change this up here. $59.82. Again, in this case, we're going to do strike price minus the stock price to determine the intrinsic value for a put. So we're going to go strike. There we go. Go strike. What did we pick? 59.82 minus 57.47. Gives us $2.34. So $2.34. And again, time value is determined the same way. It's premium minus the intrinsic value. So what is our premium here on, our premium on 59.82 is 5.3. So 5.3 minus $2.34 equals $2.96. Let's go back. $2.96. Okay. $2.96. So again, let's do the math based off what we know. $5.30 is the premium, and intrinsic value is 2.3. So 2.34 divided by 5.3 puts you at 44%. So this is about 44% This is 56%. So you're close to 50-50, right? It's not an exact, but you're close. So let's go ahead and just take a look at the next one, right? Because obviously if we go down, we're coming closer to it. And an real quick, easy way is saying, okay, $54, where are we at? Well, that's in the money, so that doesn't work anyways. So, I mean, that's out of the money, not in the money. So let's go further in the money. Let's pick now the $64.82. So let me create another box. So we're gonna go with $64.82 strike price. And we're gonna determine our IV equals this, and we're gonna have our TV equals something else, right? So let's do the math real quick. 64.82 minus 57.46. So we have, oops, sorry. We have 7.36 of time value. So let's go ahead. 7.36 of time value. And again, I mean of intrinsic value. Time value equals premium minus intrinsic value. So premium is $8.90. You already see where we're going here. $8.90 minus 7.36 equals 1.54. Obviously, you can tell that that is not a 50-50 split. So if you wanted to play the put on ARKF for the January expiration, you would be selecting the 59 and 59.82 strike over the 64.82 strike based off of looking for a 50-50 split in intrinsic and time value. They feel it's pretty much the sweet spot, and it's a good way to go. So just wanted to create that short video to explain how to another way of determining your strike price. Of course, you can select any of these strike prices, even these ones that are super in the money. If you want to build in that much cushion and have some intrinsic value in there, it's all about how much you can pretty much afford at this point. So, of course, let me know if you have any questions, and we can go through it. But I hope that example helped. And I'll probably do another video where we'll utilize the think back tool. And the think back tool will allow us to analyze and use the think back tool. It would allow us to clear all these drawings. It'll allow us to go back in time, and we can do that same math to determine. So that'll be a nice another quick video to give some kind of real life scenarios of picking ARKF from the past. We'll go back in past dates or something. We'll go to November, take a look at the chart looking at November, and determine some stuff on here, okay? So until next time, think, live, and be unstoppable. Peace.